Hello everyone, and welcome. The world of finance is a complex web, often operating behind closed doors. But in March 2023, all eyes suddenly turned to a seemingly niche yet powerful institution in California, Silicon Valley Bank, SVB. Its swift and unexpected collapse sent shockwaves far beyond Silicon Valley, raising urgent questions about the stability of the entire global financial system. Today, we're diving into the events that led to this historic bank run, analyzing the causes, and exploring the far-reaching consequences for startups, investors, and the global economy. Get ready for a compelling story of risky decisions, misguided strategies, and the fragile connections that hold our financial system together. Chapter 1: The Gold Rush and the Rise of SVB. Our story begins in a boom time. Imagine Silicon Valley in the years leading up to 2022, a gold rush fueled by massive investments in tech startups. Venture capital firms poured billions into young companies, and these startups needed a place to park their cash. That's where Silicon Valley Bank came in. Picture it as the go-to bank for the tech sector, deeply embedded in the startup scene, known for its tailored services and its fast, no-fuss approach. It wasn't a typical high street bank. Instead, it specialized in managing deposits from tech companies, their founders, and employees. Business boomed, deposits soared, and SVB became a seeming symbol of Silicon Valley's unparalleled success. Chapter 2: The Fatal Flaw, Interest Rates and Risk Management. With surging deposits, SVB faced a challenge: what to do with all that cash. A traditional bank would lend out a large portion of it. But many startups didn't need immediate loans, they mostly had excess liquidity. SVB made a critical, and, in hindsight, fatal, decision. Imagine, instead of investing the money in short-term, flexible assets, the bank poured a significant portion of those billions into long-term government bonds and mortgage-backed securities. The catch? These instruments had been purchased during an era of near-zero interest rates and offered only meager returns. Picture these bonds as long-term contracts paying a fixed, low interest rate. The real problem emerged when the US Central Bank, the Federal Reserve, began rapidly raising interest rates to combat surging inflation. Think about the value of an old, low-interest contract in a world where new contracts offer much higher interest rates. Suddenly, SVB's older bonds were worth far less. To avoid losses, the bank would have had to hold these bonds until maturity, but the money wasn't its own. It was its clients' deposits, which could be withdrawn at any time. This was a classic case of poor risk management and a mismatch between short-term, liquid deposits and long-term, illiquid assets. Chapter 3: The Loss of Trust, Rumors and the Bank Run. The spark that ignited the tinderbox was a loss of trust. Imagine rising interest rates led to startups receiving less venture capital and needing to withdraw more from their reserves. This meant SVB started paying out more money than it was taking in. To cover these withdrawals, the bank had to sell some of its bonds at a significant loss. When the bank publicly announced this move and attempted to raise fresh capital, it triggered panic. Picture tech founders spreading rumors on social media, urging other companies to pull their funds. The result was a classic bank run. Think of it as a chain reaction. The more customers heard others were withdrawing their money, the more they rushed to secure their own funds. Within hours, customers attempted to pull billions of dollars, a sum SVB couldn't meet because its assets were tied up in those now devalued bonds. This rapid and massive outflow of deposits was the immediate death blow for the bank. Chapter 4: The Aftermath, Shockwaves for Startups and the Financial System. SVB's collapse had immediate and far-reaching consequences. Uncertainty in the tech sector. Imagine thousands of startups whose payrolls, rents, and operational expenses were linked to SVB. Overnight, they were in limbo, unsure if they could pay their employees or continue operations. Picture the panic among founders scrambling to save their businesses. Contagion fears. Think about the worry that other regional banks with similar vulnerabilities might follow suit. SVB's collapse sparked fears of a broader banking crisis, leading to sharp declines in other bank stocks globally. Government intervention. To prevent a domino effect, the US government and financial regulators had to act swiftly. Imagine them guaranteeing all SVB customer deposits, even those above the insured limit. This extraordinary measure temporarily calmed markets but also signaled the severity of the situation. Chapter 5, Lessons Learned and Outlook, a New Era of Regulation. The collapse of Silicon Valley Bank served as a painful lesson. Importance of risk management. Picture how clearly it showed that banks, no matter how specialized, must meticulously manage their risks, especially in times of rapidly rising interest rates. Regulatory questions. Think about the debate over whether the deregulation of smaller banks after the 2008 financial crisis played a role and if oversight needs to be stricter. Deposit diversification. Imagine startups learning not to concentrate their funds with a single bank to spread risk. Trust is fragile. The SVB case once again demonstrated how quickly trust can erode in a digital age when rumors spread virally, leading to a bank run. The events surrounding SVB have led to renewed discussions about the stability and regulation of the financial system. It was a wake-up call, showing that even seemingly isolated issues in a highly interconnected system can have global repercussions. Conclusion. The Silicon Valley Bank collapse was a dramatic event that exposed hidden risks within the financial system. It revealed how swiftly trust can vanish and the far-reaching consequences of misguided investment strategies. The lessons learned from this bank run will significantly shape regulation and risk management in the financial sector in the coming years, reminding us of the critical importance of vigilance in an ever-evolving global economy. Outro. What's the most important lesson you take away from the SVB collapse? Do you feel that such events will impact trust in banks long-term? Share your thoughts and questions in the comments below. Don't forget to like this video, share it, and subscribe to our channel for more compelling documentaries on finance and economics. Thanks for watching.